Welcome. In this video, I am analyzing ONGC, Oil and Natural Gas Corporation. We'll be analyzing the P&L account, balance sheet, the cash flow statement and the profit and loss account. And finally, we'll look at the core ratios. And if time permits, I'll also look at the technical chart. So let's begin our analysis. By looking at these financial statements, we'll also look at the ratios of different statements and different line items. Let us begin by looking at the sales growth, CAGR, compounded growth over 5 years, 3 years and the latest 12 trailing months. In the last 5 years, from 14 to 19, the sales have grown at the rate of 19.3% compounded. So from 1,74,000 crores in March 14 of total revenue generated through sales, the total sales increased to 4,21,000 crores. In 16 to 19, the growth rate was 50% in the recent 3 years, from 1,24,000 to 4,21,000. But when we look at from 14 to 16, we see a drop in the sales. But then again, it has picked up in March 19. Whereas in the recent 12 months, we see a slight growth of around 2.72% from March 19. The average operating profit margin of the last 5 years stood at around 20%, and in the recent 3 years, although it has dropped a bit to 18%, it is still above my benchmark of 15. If we look at the individual values of March 19, the operating profit margin earned was 17.7%. The total expenses were 3,46,000 crores and the total revenue was 4,21,000. In the recent 12 months, the sales is 4,32,000, increased from where it was in March 19, and the expenses also have gone up from 3,46,000 crores to 3,66,000 crores, and therefore the OPM has fallen to around 15.2%. The other income in March 19 is contributing around 2.4% of the total sales. The company received additional income through investing activity of around 10,000 crores. Whereas if you look in March 16, the amount received was just 1,100 crores. And in the recent 12 months, other income has contributed around 7,600 crores. That's a mere 1.8%, which is low. We don't want a very high value of other income getting added to the profit, as that can fluctuate, as can be seen from March 16 to March 19 figures. We want most of the income to be coming from sales. Depreciation in March 19 was 5.7%. Of the total sales of 4,21,000, the depreciation expenses stood at around 24,000 crores. This is the value by which the assets in the balance sheet was reduced at least in March 19. In March 16, it was reduced by around 16,000 crores. This was the value of the assets written off or considered as depreciation in the P&L account. So that's a 13.2% in March 16, whereas in March 19, the depreciation percentage was 5.7. Although the depreciation value increased, but the sales also had increased to 4,21,000. Therefore, the overall rate of depreciation dropped to 5.7. In the recent 12 months, it was very nearby to 6.1%. It was nearby to where it was in March 19. The total value depreciated was around 26,000 crores. This is important to understand how the company's P&L is getting affected by the depreciation expenses and how the assets are getting reduced every year. Through these numbers, we can understand if we can actually detect potential red flags or problems in the company. If the company is manipulating its accounts, it can be very easily seen from the depreciation, as this is a non-cash expense. The raw material cost as a percentage of total sales in March 19 stood at around 65%, very high when compared to March 16 at around 30%, whereas in 14 the raw material cost was around 41%. We see that in March 19 the company's raw material cost was very high compared to the total revenue it generated. So there is of course an increase in the amount of money it is paying to buy these raw materials. It has moved up very exponentially if you look from March 16 to March 19. So this is a problematic thing. If the raw material cost increases, it creates a direct pressure on the operating profit margin. The employee cost in March 19 was only 3.7% of the total sales, whereas in 16 it was 7.4. So the sales has increased, therefore per employee revenue generated has also increased, whereas the overall percentage of employee cost to total sales has decreased to 3.76%. Interest cost or finance cost as a percentage of total sales was very low at 3%. The company is in a very good state that it can very easily pay off its finance cost. In March 19, the total sales of 4,21,000 crores, company's interest cost was just 5,800 crores. That was just 1.4%. Even in the recent 12 months, the overall interest cost is just 6,250 crores, which then indicates that the company's debt position must be very low. The company's overall borrowings will be low. That is why the interest cost is low when compared to the total sales, which is just 1.4%. The company's tax payment outgo in the recent 12 months is 41%. This would generally lower down. This is a very high rate of interest. Even in March 19, the company's outgo in terms of tax was around 38%. The company had paid 20,000 crores of tax in 2019, whereas in the recent 12 months, the total tax paid was around 16,000 crores. As we can see, the PBT or profit before tax has also dropped from 54,000 crores to 40,000 crores from March 19 to the recent 12 months. So therefore, the overall percentage, although has increased, the amount of tax paid is low. All these ratios help us understand if there are potential red flags or problems in the company. If the company is manipulating, if it's deferring its tax, then that's also a potential red flag. So we should be able to see not a wide variation in the tax structure or the amount of tax it is paying year on year. Next, let us look at interest coverage ratio. Is the company in a good financial state to pay off its interest expense of every year against the earnings it is earning, against the profits it is earning before deducting interest and tax? That is the EBIT enough to pay interest expense? We want the ratio to be more than 4 times between EBIT and the interest expense. In March 19, the overall ratio or multiple was 10 times, which is good. My benchmark is above 4 times. So on an interest expense of 5,800 crores, the company's top line profit was around 60,000, so very easily able to pay its finance cost. Even in the recent 12 months, although the EBIT has dropped to 47,000 crores, the interest cost has increased to 6,250 crores, and that is why the overall coverage ratio has dropped to 7.5. It is still high. Even in 16 it was 6.3 times. Next, let us look at the net profit margin, comparing sales and on the total revenue what is the profit it generated. We want it to be at least above 10% every year. In March 19 it had dropped to 7.2, and in 16 it was 10.4% of NPM. In the recent 12 months, NPM has dropped below 5%. On a total sales, although the sales are increasing, its overall net profit has dropped from where it was in March 19. So in March 19, the company's net profit was 30,000, whereas in the recent 12 months, it is just 21,000 crores. So quite low when compared to the sales it is doing. So we need to understand why the company's sales are increasing but the profits are dropping. So we need to understand and read about it in the newspaper or its reports that it publishes, investor reports or con call. If there are conference calls, then we need to listen to them and understand why or what is creating pressure margin or profit margin pressure on the overall sales. The average NPM, if we calculate for 1 year, it can be low, but if we look at the last 3 years, the average is stood at around 7.6, lower than 10%, which is my benchmark. In the 5 years also, the NPM was low at around 8.9. So then we need to understand over the years, if it is always generating around less than 10%, then that is its benchmark. We can also compare ONGC with its peer group companies, which we will do at the end of this video, to understand how it compares with its peer group. So the recent NPM is below its 3 and 5 years average, so which is basically a problematic thing. But 1 year we can ignore. For 3 years it is still okay, considering that it is at 7.6. Let us look at the net profit growth rate compounded. In the last 5 years, or from 5 years back, that is from March 14 to March 19, the profits have been increasing at the rate of 2.8% compounded, from 26,500 crores to 30,000 crores. In this all these analysis, I have considered all extraordinary incomes and gains also in calculating the net profit margin and other ratios of profitability. In the last 3 years, we saw that the profits have grown from 12,000 to 30,000 crores. That's a 33% growth rate. Although we see that this may be high, but when we look at March 14 value, the profits have almost become half of where it was in 14. So in 16 the profits were 12,000 crores, whereas in 14 it was 26,000 crores. So the profits have fallen, but from there again it has picked up. So this 33% as such is not a very good value, considering that it should have been increasing steadily. In March 19 to the recent 12 months, the profits have fallen by almost 30%. That is, from 30,000 crores in 2019, the recent 12 months profit stood at around 21,000 crores. So in the recent years, there is some margin pressure on the company's sales, or how much profit margin it is earning. Next, we'll look at the valuation ratio, market cap to sales ratio. This is also price to sales ratio. What we are trying to understand is how much is the company trading in the market, and against that how much sales it is doing for that year. So in March 19, the company's ratio stood at 0.5 times, which means that the company's market cap was 2 lakh crores, whereas its sales were 4,21,000 crores. So it is trading at discount to its sales. So we are getting at half the price at which the sales is taking place per share. So if we look at per share basis also, that if you are paying 1 rupee for the share, then the company is doing 2 rupees of sales on that one share. So that's a 0.5 time multiple. In the recent 12 months, it has become even more attractive. The overall sales are increasing and the market cap has dropped to 75,000 crores. So from 2 lakh crores, the market cap of the company has fallen to 75,000 crores. That's a huge drop in the market cap from 1 year back. So this is a very attractive price to buy into the company. So we'll look at the price valuation little later on. Let us look at the dividend payout. In March 19, company paid around 30% of its profits as dividend. So company earned around 30,000 crores as profits and declared a dividend of 8,800 crores for the shareholders. In 16 and 14 also it was above 30% of dividend payout, which is a good percentage when we look at 70% being almost kept with the company. In 16, the company paid a substantial amount of its profits as dividend. Almost 50% of that was paid out as dividend. Next, let us look at the valuation ratio, price to earnings, or PE ratio, that is price per share divided by earnings per share. In March 19, the company's price to earnings ratio was around 6.6 times, meaning that the company's per share earning or profit per share was 24 rupees and the company's shares were available at 160 rupees. That is, investors were willing to pay 6.6 times more than the profit the company was earning per share and buying it at 160 rupees. In the recent 12 months, or the latest price earning is 3.6 times, a very low multiple. This is very attractive. On our earnings of 16.9 rupees per share, we are just paying 3.6 times multiple, that is just 60 rupees. So the current price is just 60 rupees and we are getting an earnings of around 16.9 rupees on that share. So that's a very good multiple, or a very low multiple, or an attractive multiple of price and earning to consider. Let us look at other ratios and then see if this price earning multiple is justified. The average price earning of the last 3 years and 5 years were above 7 times, and we are getting at almost 50% of discount in price to earnings against the averages. Next, we'll continue with the balance sheet analysis and also look at the ratios of the balance sheet, and also look at the ratios of the balance sheet with the P&L account. The company's face value stood at 5 throughout 14 till 19, and the equity share capital was stable from 14 to 16, but in March 19 the number of shares have increased to 6,290. These are not the number of shares but the total share capital, that is 6,290 crores of share capital. Let us look at the return on equity. This is the profitability ratio, net worth divided by net profit, that is how much profit the company earned on the shareholders' money. In March 19, the total money received by the company from shareholders or shareholders' contribution to the company's sources of funds was 2,18,000 crores. On that, the company earned a profit of 30,000 crores. That's a 14% return on the net worth, that is ROE. In March 16, it was low at 6.5%. From on a total net worth of 1,97,000, the company's profits were just 12,875 crores. And in 14, it was above 15%. So the company has managed to return a good percentage or gain or increase its ROE in March 19. We need to look for the future years as to what kind of return it generates on the shareholders' money. We want to see at least 15% and above ROE in each year. Alternatively, we can look at its average of the last 5 years, 3 years and 7 years. So that gives us an idea where the company's averages are, and then use that as our benchmark. So over the period, if we see, it has always been below 13% for all the different years, average years, and in March 19 it was 14%. So it is above its averages of all these multiple years. Return on capital employed is again a profitability ratio. Here we are trying to understand how much total source of funds the company had from shareholders as well as from borrowings, and on that how much EBIT it generated every year, that is earnings before interest and tax deducted. Here too we want it to be 15%, or whatever is the average we can consider that as the benchmark. So if we look at the averages first, then over the years, if you see, it has never gone above 12% on an average basis of ROCE. In March 19, the return on capital employed was 18.6%, way above its averages of all these 3, 5 and 7 years. So on a total source of fund, the company had received money through shareholders and from borrowings of 3,25,000 crores. On that, it generated an earnings before interest and tax of 60,000 crores. That's a 18.6% return. In 14, it had generated around 12.9, but in 16, we saw earlier also 16, throughout the earlier graphs we have seen that 16 had, March 16 had some pressure on the overall profits. Therefore, the overall capital employed, return on capital employed also has decreased to 6.5%. Next, again, this is the third profitability ratio, return on assets. Here we are taking the total balance sheet size, or whatever assets, all the assets the company had, and then we are seeing how much profit it is generating on that total assets. In March 19, the total assets of the company, or total balance sheet, that includes your cash balance, debtors, all your fixed assets, tangible as well as intangible, all inventories, all work in progress, and everything, all assets. cash and bank balance. So that is 4,96,000 crores. On that, the net profit generated was around 30,000 crores. So that's a 6.1% of return on assets. Here there is no benchmark as such, but we can look at what past returns the company had generated on its assets. So we can see that 8.2, 3.7 and 6.1. So it is varying between different years. Moving on to debt to equity ratio. Moving on to the debt to equity ratio, March 14, March 19 and March 16 all were below 0.5 times, meaning equity contribution was always twice of what the company had done as borrowings. In March 19, the company's borrowings were 1,07,000 crores and the shareholders' contribution or owners' contribution into the business was 2,18,000 crores. So we don't want this to exceed 1 times, because if the borrowing is high, then the company would have to pay a higher interest cost and that would reduce its net profit further. So we see in March 14, March 16, we can look at the debt position individually also in this chart. In March 16 and March 14, we can see the debt being at very low at around less than 50,000 crores, whereas in the 3 years from 16 to 19, it has almost doubled to 1,07,000 crores. Ongc had to buy HPCL in a year or two back. So basically it has a 50 or 51% shareholding in HPCL. Maybe because of that it had to take the debt. So I'm not sure about that. So if someone knows about it and would want to comment, you're welcome. So the debt to equity position is comfortable. Let us see individually how much equity is and how much debt is contributing to the total assets of the company. So we have already seen that it is 0.5. So it very clearly shows here in this chart, total assets were around 4,96,000 crores and the equity contribution in 2019 was 2,18,000. This is the money which will go to the shareholders, or this is also known as the net worth of the company. That is 44%, whereas if you look at the debt position, it is 22, half of the equity contribution. That is 1,07,000 crores of the total assets. And if we look in March 14 and 16, the overall debt position was very low at 15% and 13% of the total assets, whereas the equity contribution was almost more than 50% of the total assets in 14 and 16. So overall comfortable, the company's position is still comfortable. Moving on to the price to book valuation ratio. Here what we are doing is we are looking at what is the value of the company in the market and what is the actual worth or net worth of the company. This is the book value of the company or value of the company in its own books. This is what the company is saying it is worth, actually worth, against what the market is saying that the company should be worth. So in March 19, the company's total net worth in green was 2,18,000 crores and the value of the company in the market was 2 lakh crores. So that is at a discount 0.9 times its book. That is, we are getting at a discount to its actual value. In the recent 12 months, we see a huge discount to its book value at 0.3. 75,000 crores is the market cap, whereas the company in its book is showing it is actually worth 2,18,000 crores. So this value I've taken the net worth value I've taken is of March 2019 and the market cap is of latest or the very recent market cap of 75,000 crores. So a very good multiple of 0.3 times, as low as possible. If we are getting it, we should buy it. We also looked previously between market cap and sales, market cap and earnings. We'll also look at market cap to cash. On the right hand side, we'll look at the debt position to the net profit ratio. Here what we are trying to understand is how much is the debt when compared to the profits it is earning every year. In March 19, the company had earned a profit of 30,000 crores, whereas the debt was 1,07,000 crores. So that is a 3.5 times higher debt than the profit. So this is a comfortable position. So company can pay off if it continues earning around 30,000 crores on an average over the past years, then this debt position is very comfortable, considering that within 3 years at 3.5 times, meaning 3.5 years, it can very easily pay off if it clears, or if it uses all its net profit to pay off the debt, then within 3.5 years it can pay off this debt. So that is what this debt to net profit ratio indicates, that how comfortable is this debt when compared to the profits it is earning every year. In 16 also it was somewhere around 3.5 times. So on a total debt of 45,000 crores, it was earning a profit of around 12,000 crores. So that's again exactly 3.5 times. Whereas in March 14 it was 1.8 times. So it has, although the overall debt has increased against the profits of the company, it is still within a comfortable zone. We don't want a very high multiple between the debt taken and the profit being earned, because finally or eventually the profit, from the profits we are going to pay the interest cost. So higher the borrowings, higher the interest cost. Let us look at how much is the total fixed assets of the company, and as a percentage of total assets how much it is occupying. In March 19, company's total assets or net assets after removing depreciation was 86,000 crores. So this is the total assets that the company had in its balance sheet. Of the total assets 4,96,000 crores, 86,000 was occupied by fixed assets, that is land, machinery, plant, building and so on. That's a 17.4%, which is very comfortable, because my benchmark is that net assets or net block should not exceed around 30 to 40% of the total assets, meaning if too much of money is being occupied in the fixed assets, then that is not generating profits for the company, because that's a fixed assets and that is what is used to generate profits. But as such, it is already occupied, the money is already occupied, or the capital is already occupied in the fixed assets. March 16 also it was 13.5, and in March 14 it was 19.9% of the total assets. So it has always been below 20%, a comfortable zone for me. On the right hand side, we'll look at how much capital work in progress was there, that is how much additional assets were being developed to be added to this net block in the future years. So the company was working on 69,000 crores of additional assets in March 19, meaning this 69,000 will be added to this 86,000 crores in the future year. As and when all these assets are developed, they will keep increasing the net block, and the capital work in progress will keep decreasing. So it will, as the work on the unfinished assets are going on, till that time they will remain in capital work in progress. As and when the work is finished on those assets being developed, they will be moved to the net block. I hope this is clear. So in March 19 it was just 13%. Again here too we don't want it to exceed 20 to 30% of the total assets, as a high percentage of capital work in progress indicates that the company is in a growth stage. Although it is in a growth stage, most of its money is occupied in developing assets for future growth. Moving on, let us look at what is the investment as a percentage of total assets. So here too we don't want a major portion of the assets to be in the investing activity, although this also gives us other income, additional income, and increases the net profit of the company, but this should not be the main criteria. But if you look at the trend of investment in green, from 4,700 crores in March 14, it increased to 33,000 crores in March 16 and 66,000 crores in March 19. So it has almost doubled in the 3 years. That's a 13.5% of investing activity of the total assets. It's a big percentage. Here too we don't want a major portion of the investments to be occupying the total assets, as that means that the companies, this could also mean that the company's capex or capital expenditure or expenditure on growth is done, and therefore it is transferring most of its money into investing activity. Let us look at the debtors percentage. This again, this ratio would tell us how much of the total assets are to be collected from the debtors, or how much the debtors are still to pay to the company. Here we don't want the percentage to exceed 30. So in March 19, only 3.1% of the debtors were to be collected, or money from debtors was to be collected, of around 15,000 crores of the total assets. So it's a very small amount considering the company is doing a sales of almost 5 lakh crores in March 19. So the total collection from customers was just 15,000 crores. In March 14 it was 16,000, again a low value, and in March 16 it was even less at 8,300 crores. On the left hand side we look at the debtors turnover. We are trying to understand of the current year sales, that is March 19 sales, how much was pending to be collected from the customers. In the previous chart we looked at the total assets to debtors. In that we are trying to understand that not a substantial portion of the total assets should be occupied by debtors, and in this we want to understand of the current year sales, how much was still pending to be collected from customers in the balance sheet. So 15,000 to be collected against a total sales of 4,21,000 crores, which is just a 4%. My benchmark is that it should not exceed 30% of the total sales or total revenue being generated, as that would mean that the company is not very efficient at collecting payment from its customers. Debtor days on the right hand side indicates within how many days the company is collecting payment from these customers or these debtors. And we see that from 14 to 16 to 19, the number of days it is taking to collect from customers is decreasing, which is very good considering that in March 19 it took only 13 days to collect payment from the customers. So the company is collecting very quickly money from its customers. Cash holding percentage. The company's cash holding in March 19 in the balance sheet showed 5,100 crores of cash. That's just 1% of the total assets of the company, which is a small amount. We don't want again company holding a huge cash with it when it can do investing activity, or paying off dividend, or giving out bonus or buyback. In 16 the position was at 7% of the total assets, which has decreased to just 1% in March 19. Current ratio is the liquidity ratio, which helps us understand what is the current position of the company in terms of assets and liabilities. Will it be able to pay all its current liabilities or liabilities which are going to arise in this year against the total assets it has? In March 19 we see that the company's total assets indicated in blue was 2,74,000 crores, and in green is what its liability of 1,70,000. So that's a ratio or multiple of 1.6, meaning current assets were 1.6 times higher than the current liabilities, which is a good sign because we want the company to be in a good liquidity position. Liquidity means that whether the company can pay off its liabilities using its assets, or the assets it can sell in current year. So from 14 to 16 also we can see the liquidity position was good at 1.8 and 2.1 times. In this chart we are looking at inventory percentage as of total assets, and then we'll look at how much was the sales against the total inventory holding. So on the left hand side in March 19 we see that 7.2% was the total inventory in the company. This was the amount of raw material that was work in progress of the current year of 35,000 crores against the total assets of 4,96,000 crores. So that's a 7.2%. This is also within the range of it not being more than 20% of the total assets. And when we look at how much sales the company had done against the inventory holding, that is a multiple of 11 times, meaning the sales were, or revenue generated through sales was 11 times more than what it was holding as inventory in the balance sheet. We don't want a very high inventory holding, although a high inventory holding just indicates that the company maybe the company has an order book and that it has to fulfill in this year. That is why a huge portion of the total assets were occupied by the inventory. But in this case we can see from 14, 16 and 19 it was always at around less than 12%, or rather 12 times the inventory was 12 the sales was 12 times the inventory, which has been a constant feature over the years. So most of these ratios, what you are trying to understand is trying to find out the red flags or potential problems, and we can do that by looking at how the company's growth is, or what is the percentages of the total balance sheet, and then try to understand whether there is wide fluctuation in these numbers, and if there are wide fluctuations, then that may indicate a potential red flag. We'll move on to the cash flow statement analysis. Looking at the net profit and cash flow from operating activity, this ratio is very important to understand thoroughly, because here the company is showing a certain net profit, and if that net profit is being actually received by way of cash is very important to understand. So in March 19, if you look, the company has shown a net profit of 30,000 crores, but against that the company is receiving 61,000 crores, almost double of what it has shown as net profit. That could be because the company has a high depreciation cost, or an extraordinary or an exceptional write-off or something like that, which reduces the net profit. But in actuality, if we see, the company has actually received a higher cash of around 61,000 crores. So the profit can be low, but the cash can be coming in against that net profit. So we always want the company's cash inflows to be higher than the net profit it declares. So over the years we see that the cash coming in has always been higher than the company's net profit. In March 19, the company received almost double of the net profit in terms of cash. On the right hand side, we'll look at the averages, or rather we'll look at how the company has done in terms of profit earned in 3 years, 5 years and 7 years, and against that how much cash it has received. So in the last 3 years, if we notice, 1,35,000 crores was the net profit declared, and against that the company's cash inflows have also been higher than that at 1,63,000 crores. That's an 113% higher cash coming in against the profits. The blue indicates the profit, the net profit, and cash flow from operation is indicated by green color. In 5 years also we see 126% higher cash coming in against the net profit. And if we consider the last 7 years in total, the company's profits were 2,59,000 crores and the cash inflows were 3,37,000 crores. That's higher cash than the net profit. So this is what I look at when I want to understand whether the net profit and the cash flow from operations are nearby to each other or not. In this part, we are looking at how much cash the company has earned through operating activity, and of that how much it has invested or done investing activity in terms of buying fixed assets, or rather any investing, whether it is in fixed assets or in actual investments in fixed deposits or in shares or mutual funds. So this investing activity considers all investing activity of the business, including buying of fixed assets and selling of fixed assets. So in March 19, if we notice, 61,000 crores was received by way of cash through operating activity. This is the money it earned from operations, that is cash earning, and out of that 50% was utilized in buying, or 50% of that was used in the investing activity. This also includes investing in mutual fund, as I mentioned earlier, as well as buying of fixed assets. So in March 16, if you look, 83% was used in investing activity out of the cash earned, and March 14 it utilized more cash than it earned through operations. So we don't want to look at this kind of figure persistently over the years. Rather, a half of almost 50% can be used from whatever cash the company is earning to be used in the investing activity. If the company is in a growth stage, then it can go a little higher as well, like 83% in March 16. If we look at the averages of cash flow from operations with cash flow from investing activity, There too we see a very stable percentage of, in last 7 years if we consider in total, out of the total cash earned of 3,37,000 crores, 3,17 was invested in buying of assets as well as doing investing activity. In the last 5 years, the ratio or the percentage was 87% of the cash earned transferred to investing activity, and in the recent 3 years it was around 88%. So the company has been consistent at transferring most of its cash earned from operations into investing activity, because this company is capital intensive in nature, that is, it requires a lot of investments in assets. We'll conclude by looking at the valuation ratio. These are the latest valuation ratio at a quick glance for all four to understand what is the overall valuation it is trading at. Price to earning is 3.6 times, that is, price is 3.6 times higher than the profits per share. Price to cash is 1.2, very good, which means that we are just paying 1.2 times more to buy each share against the cash it is earning on that share. Price to book is trading at a huge discount of 0.3. Its overall net worth is higher than the market cap, and when we look at market cap to sales, that too is at very good 0.2, meaning market cap is just 0.2 times of its sales. Sales is higher than the market cap. We'll look at the quarterly profit and loss account analysis now. At what is the very near term picture or what is happening in the company in the quarterly analysis. We'll look at the sales, how the sales are growing YOY and QOQ. From YOY is December 18 to December 19 quarter, there is a drop in sales of 6.7% from 1,17,000 crores of sales in December 18 to 1,09,000 crores in December 19. Whereas QOQ we see a growth of 7.8%. In December 19, the overall sales was around 1,09,000 against September sales of 1,01,000. So this has increased, but overall YOY it has decreased. In terms of profit growth, the profits have seen a fall of 47% from where it was in December 18. 9,300 crores in December 18 earned, and in December 19 the profits have fallen to 4,900 crores, a huge fall when considering YOY values. Whereas even from quarter on quarter it has fallen further to 7%. In September at least it was a little higher, but in December 9 it has further fallen to 4,900 crores. So this needs to be understood, what is happening or what is creating this kind of fall in its profits. Is this one time or would this be the recurring one? And because of this fall of 47% YOY, we also see a huge drop in its market cap, as we saw earlier when we analyzed the profit and loss account and balance sheet, how the market cap has dropped from 2 lakh crores to somewhere around 70,000 crores. Finally, we'll look at how in the quarters the net profit margin is. In December 18 the margin was around 8% on total sales. In September it dropped to 5.2, and in December 19 it has further dropped to 4.5. So we see a consistent pressure on its net profit that the company is earning. This is creating quite a pressure, but since we are also getting at a very good valuation due to drop in its profits, we can buy into this company because overall it looks very good. So this concludes my analysis of these graph based analysis. Then we'll move on to understanding the core ratios, and finally we'll look at the technical charts. Okay, in this part we'll look at the core ratios of ONGC and Oil India and compare ONGC with Oil India. The market price of ONGC is at around 60 rupees, and the results are up to date till December 2019. The sales for the current quarter was less by 6.7%, as we saw earlier in the graph, from its previous year quarter, that is YOY fall. Whereas Oil India has seen a 16% fall YOY in its sales. Net profit for ONGC has fallen by 47% YOY, whereas Oil India's profits have fallen by 50%. So the profit margin as well as sales has dropped for both the companies, and it has fallen much more for Oil India. The sales for the entire year have increased from 2019. So in 2019 the total sales were around 4,21,000, whereas in the recent 12 months it is at 4,32,000 crores. Oil India is a smaller company compared to ONGC. The total sales were 13,000 crores in 2019, and in the recent 12 months the sales has dropped. So ONGC sales have increased and Oil India sales have decreased by around 1,000 crores. The profit, when we look at 2019 with the recent 12 months, the profits have dropped from 31,000 crores in 2019 to 22,000 crores in the recent 12 months. The profits for Oil India has also fallen by around 1,000 crores from 3,900 to 2,900 crores. So the margin pressure of profits for the recent 12 months is there for both the companies. The cash earned in 2019 against, that is cash from operations, was 6,12,000, almost double of the profit of 3,14,000. Oil India also has earned almost double the cash what it has shown at profit. Profit was 3,900 crores and the cash coming in was around 6,100 crores. The stock, both of them have fallen at above 60% from wherever it was, the highest point it had reached in the last 1 year. From there, ONGC has fallen 66% and Oil India has fallen 62%. Let us look at the valuation ratio price earning. ONGC is currently trading at 3.43 times its earnings, and Oil India is trading at 2.5 times its earnings, fallen much more than ONGC and available at a lower valuation than ONGC. And when we look at the averages of the 5 and 3 years for Oil India, the current price earning is trading at below its average. Same is the case for ONGC, which is trading at its 5 and 3 years, below its 5 and 3 years averages. When we look at price to OCF or operating cash flow, it is almost the same at 1.24 times. So this is very attractive. When we look at the book value, the Oil India is trading at a higher discount than ONGC. The price to book for ONGC is 0.33 and Oil India is 0.25. PEGs for both ONGC and Oil India are very attractive at 0.95 and 0.17 for ONGC. PEG is basically price earnings to profit growth rate. So we are trying to compare, or we are comparing price earning with how the profits were growing in the last 5 and 3 years. Because in price to earnings, we are using earnings as a base to pay for the company's shares. So we want to also understand how the profits or that earnings is growing over 5 and 3 years. So that gives us a benchmark as to whether the price earning we are paying is that justified. So we are paying 3.43 times price to earnings, and that earnings is growing at the rate of 3.62% in the last 5 years, and in the last 3 years it is growing at 20%. Now in this particular chart, which I have taken up from screener.in, this excludes or all extraordinary gains or exceptional gains and incomes or expenses have been excluded from the analysis, or they have been deducted out. So this is net of that, whereas when I analyze the graphs, that included all extraordinary gains, incomes, expenses as well as exceptional items. That included, and this excludes, this analysis excludes that. So there will be a slight change in the ratios that you see on the screen. The sales have grown at the rate of 19% since last 5 years for ONGC, whereas Oil India sales have grown at 7.3%. We have to understand that Oil India is a smaller company when compared with ONGC. ROE for both the companies was around 14.9 and 13.6, very nearby. Even when we look at the averages, it were ONGC's ROE averages were better than Oil India's. Return on capital employed was also higher for all the three valuation return ratios that we are looking at compared to Oil India's. So 19 was the recent ROCE, and 5 years average was around 15 and 3 years average was 17, and the current ROCE is above its averages. Return on assets for the recent 12 months was higher than its average of last 5 years. So this is the way we try to understand how the company is doing, what are its numbers indicating. For Oil India also, the recent ROA was higher than its average. Asset turnover, which indicates what is the sales the company is doing against the asset it held in the company or in its balance sheet. The sales were 1.29 times higher than its assets, whereas Oil India's sales were even lower than its assets. So we want this multiple to be as high as possible. We want the company to do as much higher sales as possible against what assets it has in its holding or in its balance sheet. In terms of inventory turnover, ONGC has done a higher inventory turnover compared to where it was 3 years back, 13 times. The inventory turnover has lowered to around 12.5, but still good. Oil India's inventory holding is also good. Let us look at the 5 years picture or long-term picture of profit and cash flow from operations and then free cash flow. All these three things we'll look at one go. The profit declared in the last 5 years was 1,13,000 crores for ONGC. Against that, the cash coming in through operating activity was 2,44,000 crores. If you don't understand any of these ratios, you can visit my previous videos, almost 50 of them, in the playlist section, and look at those videos, understand them thoroughly, where I explained in detail each ratio multiple times. So maybe I'll just skip from here on, and because this would make the video very long if I keep explaining every time. So cash flow from operations is 2,44,000 against the profits earned by or profits shown in the last 5 years. So this is very good. We want the cash to be more than what the company is showing as profits, as I explained in the graph section as well. The free cash flow, that is the amount, this particular part I have not shown in the graphical interface. Here, there I have just shown how much cash the company had earned through operating activity and how much was done or how much of that cash was invested in buying fixed assets and doing investing activity. But in this line here, we are looking at actual free cash flow, that is how much was invested from this cash of 2,44,000, how much was invested in buying only assets, and how much was left free to be used either in financing option or doing investing activity, that is investing in mutual funds, shares, and so on. So the company's free cash flow is very good at 1,38,000 crores. So this it can use to pay dividend, bonus, buyback, as I mentioned, pay off loans, and so on. In terms of Oil India, 13,000 crores was the total profit of last 5 years, very low compared to ONGC's profits of the last 5 years. The cash earned was around 18,000 crores, higher than the profit declared, and free cash flow was almost 10,000 crores. So almost half of its cash earned through operations, whereas ONGC has a very good substantial portion of its cash earned as free cash. The average profit of the last 5 years on average was around 22,000 crores, and Oil India was earning around 2,700 crores as net profit or average profit after tax in the last 5 years. The market cap, this is the total value of the company as of today in the market. So ONGC is available at 75,000 crores and Oil India is available at 7,628 crores. So we can see the actual size of the company. ONGC is almost 10 times larger or bigger than the Oil India. Net worth wise, ONGC is actually worth 2,26,000, but the market participants have discounted it below its actual net worth. Oil India was worth around 29,000 crores, but here too it is trading at an extreme discount to its net worth. This is the time that we can buy into the company if all other ratios are also in order. Contingent liability for ONGC is around 69,000 crores. This is the hidden liability or liability which may or may not arise, like bank guarantees or tax liabilities which may arise in the future. So we don't want this to be a major portion or as a percentage of total net worth. So 69,000 crores roughly translates to around 30% of the net worth. So we don't want the contingent liability to basically exceed 20 to 30% of the net worth. In this case it is exceeding, so we have to be very careful and analyze what components of contingent liabilities are possible to come up and be added to the overall balance sheet liabilities which the company may have to pay from its profits. Oil India's contingent liability was around 7,000, almost 8,000 crores. Of the 29,000 crores of net worth, 8,000 were contingent liability. Both the company's debt to equity position is very comfortable, below 0.5. Interest coverage is almost good for both the companies at 7.8 times. That is, EBIT is 7.8 times higher than the finance cost. Promoter holding for both the company, because these are government companies, so government holding is very high, above 51%. None of the government shares are pledged. The company's debtor position is good for ONGC. The total debtors to sales percentage was just 3.26%, meaning the total debtors to be collected, or payment to be collected from debtors against the sales of 2019 was just 3.26%, whereas Oil India's collection was 11% of the sales. Debtor days is ONGC is very efficient at collecting payment from its customer within 13 days. Oil India is taking almost 34 days to collect payment from the customers. Net profit margin for Oil India is very high at 23%, at least in 2019, whereas ONGC, because it trades at a high volume and a high value, therefore its NPM value, percentage value, is low at 7.24% in March 19. The dividend yield for both the companies are very high at current market price. So at the last dividend paid and the current price, if we compare, then the yield or the return works out to 11.64% at current price. And if the company keeps paying the same amount of dividend, we can expect to generate around 11% of dividend yield every year. And Oil India dividend yield is even higher at 14%. This concludes the analysis of core ratios. Let's move on and look at the chart. This is the technical chart. I use the relative strength index and a weekly chart to analyze when and where to buy into the company. Here, if you notice, the current price is 60 rupees and there was a huge spike 1 week ago, that is 13th March 2020, and the price had reached almost 52 rupees. I'll just zoom this a little bit. So this price reached almost 52 rupees here. So these are the levels that we can buy at. The next level to buy is at 43 and 38. These are the levels that I will be buying into the company. So you can also take a call on this if you want to invest, but my buying would be at 58, 52, then 43 and 38. The reason for this gap that I won't be buying is because in the past the prices had not supported this gap. That is, the prices had moved very quickly between these gaps. So therefore I would avoid buying into this gap. Basically, I divide whatever I want to buy into multiple parts and then buy as the price falls down. Currently the RSI, both the fast and the slow RSI, relative strength index RSIs, lines are fallen below 30, which I call them as double dip, which definitely, if someone is interested, starting from almost 89 rupees or 90 rupees to 60 rupees, that is almost a 30 or 50% fall from 90 to 60. Not a 50% fall, but from 90 to 60 there is a huge fall, and these falls could have been bought at these levels of 75. Then the double dip happened at around closing price of 65.9. So from here we can start buying as it goes down and then wait for the price to move up. This is a very good time. None of the years in the past has the RSI ever touched or has done a double dip below line 30. So this is a very good time to accumulate ONGC at a price around 58 and below. Right now it is at 60. So the 65 and below can be accumulated. So this concludes my complete analysis of ONGC. Thank you for watching the video.